Hello. Welcome to the Mastering Your Credit as a Borrower webinar. Thank you so much for registering and purchasing this webinar. This is something that I put together for those who are interested in learning more about the credit system here in Canada. Maybe you're a newcomer, maybe you're a first-time buyer, maybe you're already a homeowner, but you kind of just survived through your mortgage process the first time, or maybe you're an investor who you kind of snuck into the field of investing and haven't really learned the game of credit and kind of want to gain more knowledge to be able to use it to your advantage, right? So this is essentially for you. In this webinar, we'll be talking about several different categories that lenders use to assess you as a borrower, right? It's really important to understand that when you're going for a mortgage application, a mortgage loan, that banks and financial institution, lending institutions, they use particular parameters, very particular parameters and policies and guidelines, some that are government backed, some that are backed simply by their internal policies and procedures. They are backed in order to make sure that they're fiscally responsible for handling money that they're managing, right? And so they want to make sure that if they're going to give you a loan, a mortgage loan, that you are worthy of this loan because you have the credit profile to back it up. And so I want to kind of give you the ability basically to put on the hat of a lender and the lens of a lender, so that you can best position yourself to be able to go into your next mortgage application with confidence and knowing that you're going to get your approval and you can go forward with your real estate dreams. Whether you're a first-time buyer, you can get into your first home. Whether you're already a homeowner, but you're going for that dream home and you're going for your forever home, or you're a real estate investor and you're looking to really position yourself well so that you're on your second property or third property, and you can stretch out and get to 10 properties. Really, that's your goal. And so you can kind of position yourself and move things around in the way that you need to be able to achieve your goals as an investor, right? And so let's dive into the presentation now. All right, so let's talk about this. So the significance of your credit as a borrower, right? So let's dive into this topic a little bit. I wanted to start off the discussion with this before going into the categories, because again, my aim with this webinar is to get you to think like a lender. I want you to be able to think like a lender thinks. I want you to be able to be confident in knowing that with my current credit profile, this is how the lender would assess me. This is what they'll think about me as a borrower, and I'm likely to get approved or I'm not likely to get approved, right? And so when we talk about the lender, right, we're talking about banks. We're talking about Scotiabank. We're talking about TD, BMO. We're talking about National Bank. We're talking about CIBC. We're talking about even monoline lenders, right? Monoline lenders are typically companies that only lend mortgage, right? So with the big banks, they offer mortgages, they offer car loans, they offer personal loans, they offer credit cards, they offer lines of credit, they offer RSP catch-up loans. There's so many different products, lending products that they offer. But with monoline lenders, they only offer mortgages, right? And so these companies are not any less than the big five banks. And I want to make that very clear, because a lot of people think that if they don't have a mortgage with the big five bank, then they're not, a AAA, borrower, which is not the case at all, right? There are a lot of monoline lenders who follow the same principles and guidelines of lending, and they're also government bank backed and can often be a better fit for you as a borrower than a big five bank, right? And so it's really important to know that. However, I don't want to get off topic, but lending institutions, essentially, the reason why they have these policies and guidelines in place is because they are managing public money, right? When you get your paycheck, when you get your commission check, when you earn your revenue from your business sales, you put your money somewhere. Where do you put it? Typically in a bank, right? And so this bank has to now earn profits off of the money that they get from you, right? And so we often know about, not keeping a whole bunch of money in the bank because they don't offer you the best route in earning money, in earnings, the opportunity for you to earn on your deposits and earn on your money, right? So putting your money in a savings account is not the best idea for you, right? Because you know that although they might be, well, nowadays, although they might be giving you 5%, typically they're giving you 1% or maybe even sometimes less than that. Um, but if they're giving you that, you better bet that they're probably making double or triple on that same amount that they're being able to pay you that 5% or even less, right? So it's really important to understand that this is how banks think, right? Banks are operating and functioning and managing public money. And so they are publicly traded companies. They have government investment, they have public investment, they have institutional investment. So they really have to be strategic with how they make money and manage your money and public money, right? So when thinking like a lender, um, they have to be, you have to think that if I'm going to lend someone money for a mortgage, right, probably the biggest amount of money that they're going to be approved for in their life, right, unless they want to purchase more real estate, I want to make sure that this person is going to pay me back my money, right, with what they owe on the property value plus the interest that I'm charging them on top of that, right? And so this is essentially the mindset of a lender, right? And you can think of it this way. I always like to tell people this way. If I have $10,000 and I have a friend named John who comes to me and says, Omar, I'm really in a bind and I need to lend $5,000 from you. Trust me, or sorry, I need to borrow $5,000 from you. Trust me, I'll pay you back in a month, right? And so I know that John has actually borrowed money from me before, or sorry, not from me, but my friend Paul. So John has borrowed money from Paul before, and he never paid Paul back on time. Am I going to be inclined to now lend Paul my $5,000 when I know that he hasn't paid Paul back? It's not likely. And this is exactly the same mindset and frame of mind that lenders keep, right? If you have a car loan, if you have utility bills, if you have a cell phone bill, if you have student loans or credit cards that you're not paying back on time or not paying back at all, and now you're going to apply for a mortgage, that lending company, that mortgage company, that big bank is not going to be inclined to loan you that money if they see that you can't even afford or not willing to pay back on your car loan or your student loan or whatever other debts that you might have, right? So it's really important to put your mind, the mind of a lender on when going for your mortgage application, right? So now let's take a little bit of a deeper dive into the specific categories that kind of lenders use as parameters to kind of assess each borrower that they come across, right? So when they look at your mortgage application, this is what they go through in their minds and the checks and balances when they're looking at your profile. They'll go through these categories, all right? So the first category that we're going to look at is your credit, right? Your credit slash your character, right? So your credit score is a indicator of your character as a borrower, right? So that's why I put credit slash character. And so it's really important to understand that your credit score is a primary indicator of what your borrower composition looks like as to a lender, right? So there are 5 separate categories that I've listed here that essentially comprise your credit score. All right. This credit score is very important for you to maintain as best as possible because this is the number one thing that lenders look at. They're going to look at your credit score. Many times, as a mortgage broker, I get emails from lenders every single day, multiple lenders every single day, and they're offering mortgage rate discounts and mortgage rate updates. And a lot of these mortgage rates that they're offering and the mortgage rates that you would want as a borrower, right? These are dependent upon your credit score. A lot of them, like that is the major criteria that they use to say this credit score, this interest rate for this mortgage that borrowers would want is available to people within this credit score category, right? And so it's very important that your credit score is maintained very well and that you are responsible with managing your credit. All right, so let's dive into the first category. So the first one is your payment history. Your payment history is the number one composite that feeds into your credit score, right? So it's 35%. It's weighted at 35% of your credit score. Your payment history is essentially an indication of whether you pay your debts on time, right? So you have a credit card balance of $2,000 on a $5,000 credit card, but are you paying that minimum balance every single month on time? You have a car loan, right? That you pay $350 a month. Well, nowadays car loans are looking at like, $500-$600 and up per month. Are you paying that amount every single month on time, right? You have a student loan. Are you paying your student loan on the due date on time? This is what comprises your payment history, right? So it's really important that you're paying your debts on time, and also your utility bills, right? It's really important. We'll look at this a little bit later, but your utility bills, those can sometimes end up on your credit profile as late payments, and it will show lenders that you're not willing to pay even your utility bills on time, right? So it's really important that you upkeep your payment history and ensure that you're paying your payments, your debt payments on time. Second thing that they look at is your utilization rate. Your utilization rate comprises 30% of your credit score. Now, what is your utilization rate? Your utilization rate is essentially the amount of usage of, the amount of credit that you use against your credit limit. So it's basically your credit balance versus your credit limit. So let's say, for example, I have a credit card of $10,000 and I have a balance on my credit card of $5,000. That would mean that my credit utilization for that specific card is at 50% because I've used 50% of the credit card limit, right? So now let's dive into this a little bit. When you have credit cards, you have line of credit, you have a personal loan, it's really important to understand that you do not use all of your credit. If you are approved for a $10,000 credit card, excuse me, excuse me, if you're approved for a $10,000 credit card, do not use $10,000 of that credit card, because that's going to show a 100% utilization rate. And that looks really bad on your credit profile because it shows that you need all of your credit to live or to, maintain your lifestyle, right? Which is not what lenders want to see. Lenders want to see a utilization rate of a maximum of 30% of your credit. So if I have a card of $10,000, that's my limit, I should not be using more than $3,000 on that card. That's a pretty low threshold. However, this is what lenders want to see because they want to see that you're making enough money to sustain the lifestyle that you're choosing to live, right? That you're not overspending, you're not having to depend on credit cards, but you're really just kind of using it responsibly and showing that you can manage your credit, right? And so let's say, for example, so this amount, you can kind of, if you have a card limit of, let's say, $7,000, you can do the math, right? So $7,000 times 30%, that's $2,100. So lenders would not want to see you spend any more than $2,100 on your card at any given moment. They don't want to see that balance above that amount, right? So that's really important to know. The other thing with this is, if you can keep your utilization rate at 0, it's even better, right? And so how do you do this? Every single month, what you can do, let's say you have a card again at $10,000, right? And you have, your gas payment to pay every month, you have your groceries, you have your utility bills, your car insurance, your home, or, if you have a home, your home insurance, all these different bills that you have, and you use your credit card to pay them. What you do, you set aside some money every single month, you budget it aside from your paycheck, and you pay that amount back onto your card every single month before the due date. That is going to get you back down to a 0% utilization rate, but you still use the card. This is going to show lenders that you are incredibly responsible in managing your credit, because the usages will show up. It will show that you spent this money, at Esso gas station. You spent money at No Frills or Metro or Superstore. And it'll also show that you have a balance of zero by the due date. So this is going to show that you are fiscally responsible, that you are very responsible in managing the credit that you've been granted, right? And you're very likely to be able to increase your credit score, which improves your chances of getting more credit in the future, right? So that's utilization rate. Your credit history. This is the third thing, and this comprises about 15% of your credit score. Now, this basically shows lenders how long your credit accounts have been open. Now, if you're younger and or you just new to the country and you haven't had the opportunity to develop your credit profile over some years, this might be a bit difficult for you to get around. However, still very possible, right? Credit history, why it's important is because it shows lenders that you have a long track record, right? You have 5 years, 10 years of credit history to show that you have a good payment history, that you've been paying your debts on time, and also that you have good utilization rate, that you don't max out your credit in any given month, right? You keep it below that 30% threshold and you're able to pay back your debts on time every single month. If you can do that consistently over many, many years, this is going to prove to lenders that you have a great credit history, and it's going to positively affect your credit score and show that you have a good character in managing your credit, right? Now, let me speak to those who might be a bit younger, or you're new to the country in Canada and you haven't had the opportunity to develop a good credit profile. Now, what you can do if you've been to the bank and you've actually gotten denied, and maybe you ask for feedback and they tell you your credit history just isn't substantial enough for us to give you this credit card or this line of credit. What you can do as an alternative is you can actually go for a secured credit card or a secured line of credit. Now, typically, this is essentially when you have a lump sum of cash. Let's say you have $5,000 saved up in the bank. You go to the bank and you say, listen, you've denied me for a credit card, an unsecured credit card. And so what I want to do is I have $5,000 in cash in this account. What I want to do is I want to get a secured line of credit, right? And I want to use my $5,000 as collateral, right? So that if I don't pay back that $5,000 credit card, you can actually take my cash and we'll call it even. What this will do is this will allow you to gain access to a credit card, right? That $5,000 is held in that account that you cannot touch, right? You cannot touch that 5,000. So you got to make sure that that's not like all the money you have, right? But if you have, let's say all you have is 5,000, use 1,000, use 2,000, use a part of it, right? But now you have access to a credit card. And so now you can employ the tactics of utilization, right? So you can use this credit card to pay for your groceries every month. You can use this card to pay for your gas every month, or to pay for, your insurance or your utility bills every single month. And then you bring the balance back down to zero, or at least keep it below that 30% utilization rate. This is going to help you build a payment history and a credit history and show lenders that you are responsible with your credit, even though you've been denied for credit before, right? Another option that you can do is apply to Capital One. Capital One is typical of approving credit for those who are new to using credit, or for even those who have bruised credit. If you found yourself in a situation where your credit profile has really taken a hit, just life, things happen. Capital One is typically looked at one of those companies that help you to rebuild your credit. And so if you don't have any cash saved up to really get a secure line of credit, understandable, try Capital One, try applying to Capital One, and they will be likely to approve you for a certain credit limit. It might not be a huge amount, but it will be something that can help you establish some credit and help you to rebuild your credit profile, right? Now, the next thing is public records. Now, public records are things defined as your collections on your profile, consumer proposals, or even bankruptcies, right? These are things on your credit profile that are not good, and you never really want these on your file. However, again, life happens, right? And so it's really important that you keep your debt out of collections. If you're able to talk to your lenders, if you're falling behind on payments, let them know your situation. If you can work out a payment plan that you can even pay less amounts than your payment, over a 6 month period while you're kind of, recouping some funds and able to kind of figure yourself out, this can help you to really stay on track and keep your accounts out of collections, so that way it doesn't show up as a public record on your file, right? And you avoid late payments, you avoid all those negative records and indicators on your profile, right? Now, I wanted to touch this, right? Because a lot of people have some misconceptions when it comes to having negative derogatory items on your profile. If you do have collections, you have bankruptcy, you have a consumer proposal on your credit profile, this is not the end all be all, right? One of my favorite sayings that I like to encourage myself with and my friends, sorry about that, my friends and even my wife, sometimes, life is difficult and it's challenging, and you find yourself in some situations where you just cannot get out of, right? And your only solution is a consumer proposal or a bankruptcy. And now you found yourself in a situation where your credit profile is completely destroyed, and you kind of don't know what to do from here. You're very discouraged. Please do not be discouraged, right? I want you to understand that a consumer proposal and a bankruptcy can be a very strategic move if you understand and know how to plan moving forward, right? And so another thing to consider as a mortgage broker, right, that shocked me when I first started, is that there are still a lot of lenders that will be willing to lend you money for a mortgage, even with a consumer proposal or bankruptcy on your profile. Yes, it is possible to get a mortgage even with derogatory items on your profile. Now, the caveat to this is that that mortgage is definitely going to cost you a lot more, right? In terms of interest rate, in terms of down payment, in terms of, fees that will come along with it. You're gonna have to spend a little bit more to get that mortgage. However, these products and these lenders can help people who may be in a bind of losing their homes, having to go into foreclosure, having to go through power of sale, and all this negative, this negative process that not even the lender really wants to go through because it's really expensive to do a power of sale. They might not recoup their funds for the house, and they might, it's just a long process that they don't want to have to go through. You definitely don't want to go through. And so it's really, really important to understand that there are other lenders. They're called B lenders, subprime lenders, or also called alternative lenders. So they're all the same under the same umbrella of lending. However, they're basically there for those who don't have that AAA rating of a borrower that could fit into like a big bank or an insured mortgage, right? And so you're definitely going to have to come with a little bit more down payment. There are some fees that are tacked onto that. However, again, and the thing that comes to mind is maybe someone that has a mortgage. You're a current homeowner, you have a mortgage, and you're just not able to keep up with your payments because life happens, right? And so now you found yourself in a time of when you're renewing your mortgage, the bank comes to you and says, "Hey, listen, we see that you have a lot of missed payments on your history with us, and we actually don't want to renew you. And so you're gonna have to find another letter, or we're calling your mortgage. You're gonna have to find another lender to take on your mortgage." Now, this situation can be very scary. However, if you work with a good mortgage broker and you're able to put a good story together, this mortgage broker can take you to a subprime, an alternative lender that will be able to get you into a mortgage that will keep you afloat, right? So this is something really important to understand, right? Just because you have a negative file, negative derogatory items on your file does not mean it's the end of the world. There's always a way out, but you just have to work with the right professionals that are knowledgeable and that can communicate well what your story is to the lender, that you can show that you can actually afford to pay this and you will pay this and you're committed to paying it. However, life just happened to you, right? So that's something I wanted to discuss and talk to you about. And if you do find yourself in this situation, reach out. I'll be happy to talk to you about your situation and what possibilities might be available to you. right? Last but not least, we have inquiries. So inquiries are, any place that you go to apply for credit. It's going to show up once they run your application and they run your credit. It's going to show up as an inquiry on your credit profile. Now, this inquiry shows lenders that you're looking actively for credit, right? You're looking to either get some credit or increase the credit that you already have. Now, it's important not to look for credit too often, right? So if you find yourself in a place where, let's say you have a credit card, right? And so now you're looking for a credit card, so you have a credit card and you're looking to you have a credit card limit of $5,000 and you're looking to increase that limit now to maybe 7,000 or 8,000, 8,000, $10,000. What you're going to do is apply for that credit, right? But because of various circumstances, they deny you. Once they deny you, do not apply for credit again until another 6 months, right? Do not apply for credit until another 6 months. Why? Because if you apply for credit too often and too frequently, it's showing lenders that you are desperate for credit, that there must be something going on, that you're overstretching yourself every month, right? That you're needing extra money to loan and to borrow to upkeep your lifestyle, right? So this shows a little bit of desperation on your file and it's not good. And so it's really important to space out your credit applications and requests. Um, this same principle does not apply for mortgages, right? Or even car loans for that matter. Anytime the credit is applied to a secured asset, to an asset, so a house, a car, lenders typically look at this in a different way. Because if you're asking for money without any asset, right? You're just asking for a credit card or a line of credit, but there's no really reason why you're giving. Like you're kind of just saying, I'm going to use it for, emergencies, or I'm going to use it for, whatever. You can say anything on that application and the bank's just going to have to believe you, right? And so that's why they're a little bit more wary to give out unsecured debt. However, if you're applying for secured debt, you're going for a car loan, you're going for a mortgage, that debt is directly attached to an asset. And so with that, the lender knows that if you don't make this payment, I can recoup at least some of my funds by taking that asset, by taking back that car, by taking back that house, selling it off, and trying to pay down some of that money that is owed on our books, right? And so I'm not saying to go crazy applying for car loans, but if you're in the market for a car, don't be afraid when you're going to different dealerships and they're running your credit, right? Yes, it's going to still negatively affect your score. However, lenders will not look at it and say, well, you're looking for a car loan or you're looking for a mortgage. That's a horrible thing. Everyone needs a car in the society and everyone needs a home in the society as well. So lenders are not going to ding you as hard if you have these types of inquiries. However, if you have credit card, applications and line of credit applications, personal loans, these are things that lenders typically don't want to see too frequently because it shows that you're really desperate to get these. All right. So debt is not necessarily a bad thing. It's just how you manage your debt that matters the most, right? So this is something that I had to learn, and I want to share it with you, especially if you're someone that does not come from Canada and your home country operates on a very cash-based system, that you only buy something when you got the cash in your hand or in your bank account. This system in Canada does not operate the same. And it's really important to learn how to build a strong credit profile that you can have access to money and do a lot of things with, right? Let's go into the next part. Capacity. So we're talking about capacity. Now, what does capacity mean? Capacity is your ability to manage what you have in your hands, right? So lenders are basically going to be looking at your current financial situation. So in your current financial situation, what is your income? What does your income look like? Are you earning, $1,000 one month and then $5,000 the next? Are you a salaried employee that you're earning, $4,500 every single 2 weeks, no matter what, because you're on salary, you're a permanent employee, with the federal government, right? This is going to directly show your capacity to handle debt, right? So this is why a lot of times people are scared when they apply for mortgages, when they shouldn't be, when they don't necessarily fit in the box of being a permanent employee, having a super stable paycheck every single month. Yes, it does help you to apply and qualify for cheaper mortgages with better rates, because a lender is assuming less risk, right? Remember in the first slide, we talked about the lender's responsibility to be prudent with public money. So if you're showing that you have less risk because you have a stable paycheck, of course, you're able to access a better interest rate because there's less risk, right? So they're going to reward you for that. However, if you're a business owner, right, and your income is not as stable, you can actually still qualify, right? If you have been a business owner for at least 2 years, 3 years, and you're able to show that over the past 2 years, your income is at a specific level, you can still qualify for these great rates, right? It's just that your process toward that mortgage looks a little bit different, right? The lender's just doing their due diligence and making sure they're managing that public money very well, right? And so income stability is a big factor when it comes to a lender assessing your capacity to manage the debt that you're about to take on, right? One thing that I want to also discuss is your DTI as a borrower. DTI stands for debt to income ratio, right? So debt to income. So it's a ratio that is used to essentially calculate how much debt you have against how much income you bring in every single month. So how much money is going out against how much money is coming in, right? That's how you can think about it. So your debt to income ratio, a healthy amount is 35% or less, right? This is not specific to mortgages, right? Mortgage ratios, mortgage debt ratios, sorry, have very specific ratios that show that banks use to assess that is government backed. These are policies that are government backed. And so this specifically is something that's very personal for just you and your advice for your monthly budget, right? A debt to income ratio that you have of 35% or less is very healthy, right? So you never want to be spending more than 35% of your income on any debt payments that you owe every single month, right? So how do you calculate your DTI, right? If you're not a mathematician, I'm not either, but this is very simple math. You'll get it, right? So first thing you do is calculate all of your debts, right? So let's say, for example, we look at the example here. You have a $500 car payment, right? You have a $350 student loan, right? You have a $150 credit card payment. That equals out to $1,000, right? So very easy math. Let's make it easy math. $1,000 a month that you put out on debt payments every single month, okay? And your monthly income net after taxes is $5,000, right? So don't pay attention to the formula. I know it can be confusing. Just focus on that second line in the equation, right? Where you have the equal sign. Once you can look at it this way. So $1,000 every single month that you pay out in debt payments against divided by $5,000 of your income, right? That's going to equal about 0.2, right? You're gonna get 0.2. With that 0.2, multiply it by 100, and that's gonna be the percentage amount of your debt to income ratio. That is your debt to income ratio. So in this example we have here, this is a debt to income ratio, a DTI ratio of 20%. Right? So this individual would be paying 20% of their monthly income toward debt payments. And this would be considered quite healthy, right? Because it's less than that 35% threshold, right? Now, I want to kind of stick here for a little bit because in the mortgage world, right, according to the government, if you have a debt ratio, right, there are different types of ratios. There's a GDS ratio, so a gross debt service. And this is essentially your mortgage payment plus property taxes and your heat divided by your monthly payment, your monthly income, sorry, right? So this is very specific to mortgages, right? And that threshold is 39%, right? And then you have your TDS, your total debt service ratio, and that is your mortgage payment. So the GDS plus all other debts that you owe. Excuse me, sorry about that. So your TDS ratio is specific to your mortgage payment plus all other debts. So it encapsulates all your debt against your monthly income, right? So this is how lenders, this is the calculation that lenders use to basically assess you to see if you have the capacity, right? The capacity to manage the mortgage you're about to take on, plus all other debts that you have, right? So during the pandemic, the government actually raised these limits a little bit from 35% GDS to 39%, and 40. They went from 42% TDS up to 44%. So now up to 39% of your income should be used for mortgage, according to the government, and up to 44% of your income every month should be used for your mortgage payment plus all other debts that you have, right? Now, this can qualify you for an insured mortgage. This does not stand for other lenders who are alternative lenders or B lenders or subprime lenders, right? These lenders can often go, I've seen up to 55% GDS and 60% TDS, right? Now, this is in extreme cases. It's never good to be spending that amount of money on a mortgage every single month, aside, as well as all your other expenses, because now you're kind of digging yourself into a deep hole and you don't have much money left over every month, right, for yourself to achieve your other goals, investment goals, your savings goals, and things of that sort. You're spending a lot of money. And so it's really important to be sure that you can try your best to keep that ratio as low as possible. Now, if you live in Toronto, Vancouver, this is definitely a taller task than it sounds like, because more, housing costs are really high. But definitely there are strategies around this, and that's not something I want to discuss here. But I wanted to kind of talk about capacity in a mortgage context. So your GDS and TDS ratios, that's essentially the capacity category, and those ratios are what mortgage lenders use to assess your capacity to manage the mortgage that you're applying for. Okay, so let's go to the next part here. Excuse me. So your capital, right? So capital is essentially how much money you're bringing to the table. That's how you could think about it, right? So the capital that you are bringing to the mortgage deal, right, to the mortgage transaction, should be in Canada a minimum of 5%, right? Now, a lot of people think that only first-time buyers can qualify to put down 5%, which is very untrue. The guideline and the policy is, if you are living in this residence that you're purchasing as a owner occupied, so you're going to be living in this property as your primary residence, you are eligible to put down as little as 5%, right? So that's something that's very important to note, that let's say, for example, you already have your first home and you're looking to purchase your next home. You do not have to come up with 20% of the purchase price of that home in order to qualify for a mortgage. All you have to do is come up with 5%. Now, if you're doing business with a specific builder, or you have specific stipulations in the purchase agreement, the purchase contract, then maybe that 5% won't apply to you, right? Because you're agreeing to different terms. But according to the government policy, you only have to put down 5%, right? And so that's what you need, right? So that's what you need, capital. So the lender wants to see that you have a minimum of 5%, or the minimum amount that the seller is requiring of you, right? So you'll often actually see that new home builders will charge a little bit more than 5%, right? A lot of them will charge maybe 6%, maybe even 7%, some even 10%, right? I've seen that as well. So they'll charge 10% of the purchase price, even if you're going to be using the property as your primary residence. So it's really important to understand what the seller is requiring of you, right? So they want to see, the lender wants to see that according to your contract, that you are coming up with the capital that's required. Not only do you have to consider the down payment, but you must also consider closing costs, right? And this is something that is sometimes also really difficult to come up with, because it can be quite expensive, right? So your closing costs are typically 1.5% or up to 4% of the purchase price of the home, right? So depending on the type of transaction, the real estate transaction that you're going into, that price varies and it fluctuates, right? I want to say basically, if you're a first-time home buyer throughout Canada, your closing costs are going to be much closer to that 1.5%. I can tell you personally that when I purchased my first home, it was a condo, a two-bedroom, two-bathroom condo in Ottawa, on the west side of Ottawa, and the purchase price was about $320,000. I think our closing costs, if I remember correctly, were close to about $4,000 or $5,000 in that range. So it was very, very minimal. Even shocked me how small it was and how little it was, because in my mind, I think I was budgeting about $10,000 just to make sure that I had enough to cover everything and wouldn't be left without any cash left, after the transaction. And so I was very pleased to find that out. Now, what do closing costs? What are they so comprised of? Or sorry, let me touch on this actually before I move forward. So if you're not a first-time buyer, right, those closing costs are definitely going to increase, and namely because of the land transfer tax, right? You get a land transfer tax rebate when you are a first-time buyer. But when you go to purchase your next home, that land transfer tax rebate does not apply to you anymore. So you're going to have to pay that out of pocket. And this is a big reason why your closing costs increase when you are not a first-time buyer, right? It's really important also to understand what your closing costs are comprised of, right? So the main thing that people consider are lawyer fees. In most real estate transactions, if not all real estate transactions, lenders are going to require you to have a lawyer to represent you in the transaction, right? So lawyer fees can range. I've seen some as low as $800, $900, up to even $2,000 or more, right? It really depends on the law firm that you're choosing, maybe also the type of transaction that you're doing as well. If it's a super complicated transaction, I'm sure the lawyer is probably going to charge a little bit more because you're going to be doing a little bit more reading, a little bit more tightening of your contract and making sure that you're well represented in the transaction. If it's a simple, for example, for me, when I did my first purchase, it was a very simple transaction. First time buyer, we purchased, my wife and I, we purchased a property from a home builder out here in Ottawa. Very, very straightforward transaction. And so I think we ended up going with a law firm that was, very cut and paste and dry. We paid about $1,000, right? So that was something that was pretty standard that I think for us. So lawyer fees are definitely a big portion of those closing costs. You also have to pay title insurance. Title insurance usually costs around $200, and it's something that is mandatory and covers you in the case of fraud. One thing that some people might do is they can literally list your property for sale. Let's say you go on vacation or something like that. Someone gets into your property, whether they break in or where they have access, they can list your house for sale. And if there's no title insurance, it will not show on the registry as you are the rightful owner of that home. And if that's the case, someone else can purchase that house from you under your nose, and you will be left without a home. And if that person gets title insurance, then that means that they're going to now be the rightful owners according to the registry, the title registry, right? So title insurance, it is very important that you get that in every single transaction, every single real estate transaction, to protect you and your asset, right? Your home, your property, any property that you own, whether it's rental, personal, primary residence, it is your asset. And it is important that you do the due diligence to protect that, right? And it's only $200, right? So $200 in the grand scheme of things. I mean, you've already shelled out $50,000 on down payment. Why not pay a $200 fee to protect your asset, right? For posterity. The other thing is inspection fees, appraisal fees. Those can often be around $500 each, $600 each. Inspections are really important, especially if you're getting a home that is pre-existing. So someone else has lived in the home. If they haven't maintained it well, you would never know unless you get an inspector, right? I've also heard of people getting inspectors for homes that are done by home builders, right? Sometimes home builders can, especially during pandemic, we're hearing a lot of stories of home builders getting cheaper materials and cheaping out on the quality of build of these homes. And so getting a home inspector for your PDI or even after you move in can be something that's really important to do. It costs generally around the $500 mark for each of those, appraisal as well. Appraisers will come to your home, they'll assess your home and value the home based on comparisons of other homes that were sold in your area, right? And that match the specs of your current home. Sometimes a survey will need to get done, right? So a survey of the land will need to get done for various reasons, right? Sometimes the home that you're purchasing might be on leased land. So the home that you own the home, but maybe not the land that it's built on, right? There are complex scenarios in that sense, right? And so a survey can really help you in that sense. And so there are a lot of other things. And the last thing I want to touch on is that land transfer tax portion, right? This is a big one, especially if you're in the Toronto region, right? So typically, the land transfer tax is a specific amount, usually around the 1% mark in most cities. However, Toronto has a premium because it's so overpopulated that you pay an extra 1% fee. So instead of paying 1.1%, I think it is in Ottawa, about 1.1 or 1.5%, close to that in that range. That's how much a land transfer tax is. In Toronto, you'll pay that same 1.1 or 1.3%, and then you'll also pay another 1% on top of that. So in total, for land transfer tax, you're paying about 2.4%, 2.3% for your land transfer tax. And that can be quite expensive depending on the appraised amount of your home, right? So that can really be quite expensive. And so the real estate transaction can be really expensive. Closing costs can be really expensive depending on the type of transaction. If you're getting a subprime mortgage, a B lender or private mortgage, even if you're an investor, you'll probably be into using private mortgages to flip homes or something like that. Those can be quite expensive because on top of paying all these other fees, you're not also paying a broker fee, right? You're paying a lender fee, right? Lender fees and broker fees can typically range from 1% even up to 3%, right? Depending on the type of mortgage you're getting. So it's really important to work with a broker and a lawyer and other professionals that can really help you through this process and give you an idea of what to expect with your transaction, right? And yeah, talked about the first time buyer land transfer rebate there. So that's good. Collateral. Let's talk about collateral. So collateral is something pledged as security for repayment of a loan to be forfeited in the event of a default. All right. So collateral can be anything of value that you put up as collateral in space of getting you a loan or some money back or some funding, right? So in the real estate world, the collateral is always the property, right? Or a piece of land, right? Those are always the collateral that you're going to use in order for a bank or a financial institution to lend you money, right? That home, that piece of property, or that land is the collateral, right? But in a general sense, cash can be collateral, right? We talked about the secured credit card earlier, where you have a savings account with, $5,000 or $2,000, and you use that as collateral for a credit card that the bank will give you in exchange, right? A car can be collateral, right? So a bank or a lender will give you money to loan on a car, right? That the car would be collateral in that sense. And so lenders provide borrowers with mortgages with property as security, right? So it's important to understand that when when you're getting a mortgage, just because it's a home or just because it's a piece of land, the lender, and just because you qualify and you're a good borrower, doesn't mean that the lender is just going to give you the money. Because not only does the lender look at you as the borrower, but they also consider the property. They also consider the security or the collateral or the asset that you're looking to borrow against, right? If I'm a lender and I'm looking to lend money to a borrower who's come to me, right? And the property that they show me that they want to buy and purchase for an asset is in the middle of nowhere, There are not any neighbors. The house is run down. It's, boarded up. The land is not well kept. I might be a little bit hesitant to lend on that property because if anything happens and you're not paying that mortgage and I need to resell that property to kind of recoup some funds, is it going to be easy for me to sell that property as is, right, without having to put any work into it to get some money back, right? Because again, remember, lenders are in the business of managing public funds. So they're going to try and do their due diligence to make sure that they're not putting themselves in a precarious situation by lending on a property or an asset that is not up to market conditions and would be very difficult to resell, right? So whenever you're coming to a lender with a property, make sure that's in good condition, right? And that's why it's important, particularly for pre-existing properties, to get an inspector, get an inspection done. That if there's anything, wrong with the property, the inspection would reveal that you can now pin the seller on it to say, hey, you need to fix this before we go through with this transaction, to make sure that I'm in a good position, that the bank is not worried about them loaning me money and this deal doesn't fall through, right? And so it's really important. Not only do they consider the location, but they consider the type of property, right? Not just the condition, but the type of property, right? A bank and a mortgage company are much more likely, and they want to lend on, single homes, right? So a single home is very easy to lend on, right? Very easy to resell, very easy to be attractive to many people. Most people have a single home as their dream home, as their forever home, right? Where they kind of grow their family and they have all the rooms in the house that they need. They can have the dog and the white picket fence. Very, very easy to resell, right? As opposed to, let's say, for example, a cottage, right? A cottage might be a little bit more difficult to sell because not everyone has the idea or the dream of purchasing a cottage, right? Or maybe even a commercial property, right? These are some of the things that lenders will consider, right, as a type of property that they're lending on, right? So you have to think, if I'm a lender and I get in trouble, would it be easy for me to take this asset back from the borrower and resell it at market value or maybe even more and make some money off it to pay off the debt and write off the debt? Or if I lend this money, it's going to be really difficult for me to now, take this property back and resell it on the market at market value, right? Is it going to be easy for me to resell that quickly so that I can recoup my funds? So those are some of the things that you have to think about when you're purchasing property, you're going in to invest in real estate. These are some of the things, right? Especially as an investor, actually, it's really important to understand this piece, because you're basically taking on the mind of the lender, right? So in the worst case scenario, the lender will repossess the home, right? The collateral, the asset, to resell it to cover the loan that's left unpaid by the borrower, right? And God forbid you would ever be in this scenario, but this is essentially what the bank or the lender will do in case of non-repayment and foreclosure, right? And so we'll look at this category here is the conditions, right? Lenders will always consider market conditions. Now, during the pandemic, a perfect example of this, right, is during the pandemic, a lot of borrowers were having trouble because interest rates got so high, right? And so during this time, a lot of banks developed policies that you could actually defer your mortgage payment for a period. I think it was 3 months, if I remember correctly, whether you could defer your mortgage payment for 3 months, that you can kind of lick your wounds a little bit, recoup some funds, and get back on the right track, right? So mortgage lenders will always, always look at market conditions because they're not in the business of keeping you from lending money, right? They make money when they lend. So they want to lend the money, but they just want to make sure that they're lending the money, to the right borrower for the right property, and they're considering the conditions as well, right? So if you are in, a case where even now where interest rates are still a bit high, they're not going to really move and budge on the interest rate if, you need to lower your interest rate or anything like that. However, if you're currently in a home and you're having a little bit of trouble, reach out to your lender because they understand that the condition right now economically in Canada is not the best. And so instead of you getting in trouble, going through foreclosure, they will consider the conditions and you can most likely work something out, right? As long as you can show that you're willing to pay and that you can pay over the long term of this mortgage term, it will be something that was useful for you, right? So they consider the conditions. So sometimes you could be the perfect borrower, right? But just because of the market conditions, maybe in the city that you live in, right? Maybe there's flooding in the situation that you live in. Maybe there's been a lot of forest fires in the city that you're in and you're trying to purchase in. The lender is going to consider this, and though you're the perfect borrower, they may not be willing to lend on that property that you're looking to purchase simply because of the conditions around it, right? And so this is something important to think about. So it might be the economic climate, it may be the environment that you're looking to purchase in. And this can help you to position yourself strategically that, let's say if I'm an investor, I'm not going to invest in a property that I know that is prone to flooding because a lender's not going to want to lend money on this, right? Or if I get a lender, it might have to be an alternative lender. And not only will that be more expensive, but my insurance costs will be expensive. If I have to file a claim to clean up a flood in the home, it's going to increase my mortgage premium, my insurance premiums every month. So these are certain things to consider, right? Now let's move on to the next. Oh, yeah, let's move on to the next slide here. So if you're in a situation, right, where your credit is not the best, like I said before, you have derogatory items on your file, you have some public records, you have some collections, you just came out of a bankruptcy, or you're in the middle of a bankruptcy, there is a way to still improve your credit and keep yourself afloat, right? Don't give up. Don't give up. There is hope. Okay. So how do you improve your credit score, right? Number one, utilization is key, right? So let's say, for example, you've had all your credit cards written off, you've had to go through a bankruptcy or a consumer proposal, and you're really in trouble right now. What you can do, get a secured line of credit or try to apply through Capital One, right? And then use the credit card that you're able to secure and use up to 30%, no more than 30% every single month, right? This is going to help you to show the lender that you're not depending on the credit card, but you're still using it, right? You're showing them that you can still use it and you're using it very responsibly, right? You still want to use it to some degree because it has to show up on your file somehow, right? If you don't use a credit card at all, right, you can't be scared to use it. You just have to be disciplined in how you use it, right? Because if you don't use it, the credit card company is not going to see that you're using your card. It's not going to show up on your credit file and it's going to remain stagnant. But what you want to do is use your credit card, but use it responsibly, right? So maybe you just only use it for gas, right? Or you only use it for groceries, right? And you make sure that you pay it off as soon as you pay that, right? So let's say you buy gas for $50, you fill your tank, you get in the car, you have the cash, you put that $50 right onto your credit card immediately. That's a way that you can use your credit card wisely and that will positively impact your credit score and your credit profile. Okay. The next thing is pay your bills and your loan payments on time, right? I'm not going to belabor on this. We talked about this, but getting too far behind on your car payments or your debt payments is going to really, really hit your score. So if you can catch up, talk to your lenders, right? Talk to your companies, see if you can work out a payment plan that will really help you, right? Even if you those derogatory items, continue to pay it on time. Continue to pay it on time and make a habit of it. This is going to show that you don't have as many debt payments and you're willing to work at continuing to pay it on time, right? Refrain from unnecessary hard credit checks, right? So the hard credit checks are ones that will negatively impact your score. And typically you can look at it this way. A hard credit check is anytime an external company, so someone external to you, so a car loan company, a car dealership, a mortgage company, a phone company, Rogers, Bell, Telus, those kind of companies, anytime they hit your credit, it's going to show up as a hard credit check and it's going to show up as a negative item on your file. But again, remember, if you're applying for a mortgage, if you're applying for a car loan, it's tied to an asset. And so you're not just looking for credit, but you're looking for something that's useful, right? So refrain from too many of them, right? Try and space them out. I always say the rule of thumb is 6 months, every 6 months, right? So if I'm going to apply for credit, I'm going to try and apply for credit, in January or whatever, February, March. And then once I do that, I get the credit that I need, or I don't get the credit I need. I'm going to take my time and wait 6 months before I apply again, right? Once you've paid off old accounts, leave them open. So if you're in a situation where you've maxed out your credit card and you've just been in trouble this whole time and you say, you know what, I'm going to work to pay it down. You pay it down in a year, 2 years, 6 months, whatever the case. Once you've paid it back down to zero, do not close the credit card. Cut it up if you don't want to use it again, right? Just cut it if you just don't want to go down that road again, but leave the account open. Why do I say this? Because if you leave that account open, it's going to show that you have a good payment history. But if you close that credit account, it's going to lengthen the time of your credit history. So let's say, for example, you have a credit card and you've had it from high school, not high school, college, sorry, right, from university. You had a $1,000 or $1,500 credit card, right? And over the years, 10 years, 15 years, you've had that card and you've gotten increased over time. And what happened was you got to a point where you've kept it maxed out, you got into financial trouble, and now you've gotten to a point where you've paid off that card, right? You've had it for 10 years, and you cut it up and you tell the bank, hey, listen, I want to close this account. I just want to get rid of it, get it out of my hair. You close that account, that 10 or 15 years of having that card now goes away. And the next in line is going to be, whatever, if you got a car payment the last 5 years, that's going to show as your credit history. So instead of showing that you have a credit history of 15 years or 10 years, it's going to show that you have a credit history of 5 years. Right. So it's really important that you keep your old accounts open, even if you don't use the cards, like hide it from yourself, or cut it up, but leave the account open. Okay. Because this is going to help you with a credit history. So these are some ways that you can improve your credit score. This is not an exhaustive list, but these are a few things that will definitely help you to improve your credit score if you find that you're, within the 500 mark or even low 600. Now, if you are a young person, you're a student, you're just a recent graduate, or you're new to the country and you're looking to establish some credit, what are some things that you can do to establish your credit profile in this country? You can actually get a student credit card. If you are in university, they give them out like candy, right? I remember when I was in university, I opened an account and I got my student account, and they saw that there was money coming in. They just gave me a student card of like a limit of $1,000. It's not much, right? $1,000 when you're a student, you can easily get that back even in tax credits, right? And there were times that I would max out that $1,000 card. I would get my tax return and slap $1,000 and pay it down, right? And so it's an amount that's definitely not going to ruin your life, but it's a way to build your credit, right, and establish some credit for yourself. So again, keeping that threshold of 30%. So if your limit is $1,000, keeping that usage under $300. So maybe I'm paying my groceries on it every week, and I slap cash down back onto it, or I'm buying gas. These is a good way to establish some credit, right? Another way, and this is for someone who maybe you're a parent and your child needs to establish a good credit profile, and you know that you're good and very fiscally responsible with your credit. You have a good score, you have a 700 or above or 800, and you want to be able to establish credit for your child early. You can actually, I think once they hit 16, you can add your child as an authorized user on your credit card, right? So once you do this, if you add your child, right, who's 16 years of age at least, as an authorized user, what this will do is the same credit file that you have for this card, the same usage and your responsible use of this card is not just going to benefit you, but it'll benefit your child who you've listed as an authorized user on your credit profile, right? So this is a way that you can establish credit for your child even before they turn 18. So by the time they turn 18, especially if you're strategic in terms of real estate investing, you want to get your child's feet wet in the game. When they turn 18, they don't really have to wait, to establish credit. They already have 2 years of established credit by 18, or 3 years by 19, or what have you. And they can get maybe larger amounts of credit, right? Right off the bat. You can continue that trend of good utilization, that they can really get a head start in terms of their credit usage and their credit profile. right? Again, another way, if you are trying to establish credit, is getting a secured credit card. A very, very, very good way to get it. It's almost guaranteed because you have the money as collateral to give to the bank. So if you do not pay it back, excuse me, they at least have that savings account of your cash as secured, as a secured collateral, right? So this is a great way to establish credit. If you're new to the country and you've been struggling to apply for credit cards and you've just been denied, or you're young, you're a student, or you're a recent graduate, and you just haven't had the opportunity or maybe confidence, right, to apply for credit, this is a great way to start. A great way to start, right? Another way is to use a cosigner to help to establish some credit. So if you're looking to get a car loan, you're looking to get a mortgage or any other loan, right? Or a credit card, one thing you could do is have a cosigner sign on file for you. Now, this can be very tricky, very delicate for a lot of people. However, this is another method that you can use. If there's someone that you trust and that you know that they can trust you and that you're not going to ruin their credit file and you'll pay your debt on time, you can actually ask someone who has a greater income, a better credit profile to co-sign for you to show that in the lender's eyes, if I don't pay this money back to you, this co-signer will be on the hook and you can get recoup your funds from them. Right now, this is the worst case scenario, right? You're going to pay your debts on time and not ruin your friend or your family's credit. But this is a strategic way to get some credit and establish some credit if you're not able to get it on your own, right? For whatever reason, maybe you don't have a credit profile, maybe your income is too low. These are some great ways to establish some credit. All right, so that's it. That's my presentation. This is kind of a, I like to look at it as a quick masterclass on looking at the borrower as a lender and seeing how the lender assesses you. I hope this was a very productive and fruitful presentation for you. And if you have any questions, feel free to reach out to me. Email me. You can shoot me a text message on my phone number. That is my direct line there. You can feel free to shoot me a text. Email me there at ogenis@mortgagealliance.com. I am more than happy to take your questions. If you have good feedback, negative feedback about the presentation, also let me know. You can find me on social media. My handle all across the board is Genus Mortgages. You can find me on Facebook at Omar Genus. You can find me on Instagram, Genus Mortgages, TikTok, Genus Mortgages. You can find a lot of informative posts on those files. And yeah, this is it. Thank you so much for your time. Again, really hope that it was productive for you. And reach out to me for any questions at all. I'll be more than happy to take your questions. All right. Thank you so much once again. And I hope to see you soon.